Guys, before we kick off, I just want a quick message from our sponsor, me. Yes, that's right, my 12-month property investment mentorship program, the Accelerator, that is kicking off again. We're actually opening up and we're allowing new members to join. So please do consider jumping in. It's got the mentoring and coaching. It's got the systems and strategies for busy professionals and business owners who are looking to build a portfolio that is capable of generating sufficient passive income for them to be able to basically take their foot off the gas and ease back a little bit. Like, you might love what you do, but will you have the same energy, enthusiasm for what you do, say 5 or 10, 15 years from now? The idea is just to give you options. And so that's what the principle of the course is all about, the program. And there's also an element of accountability and networking, community and stuff like that. So guys, if that sounds of interest to you, please go to the show notes and have a look for the discovery call. Just book yourself in for a call with me to discuss the program. What's up, guys? Welcome back to another episode, and I hope you're enjoying the fine weather here in Dublin or anywhere, wherever it is in the world that you're listening in from. But we had a scorcher today and my face is a bit burnt. So those of you watching in on YouTube, you understand why. I'm going to introduce you to our guest now in a moment. But today's episode, I think, is going to be a real eye-opener for a lot of you that are starting out in property and you're trying to get your head around how do you finance something that is just beyond your reach. My guest today is Ray Glimp. And Ray is from West Virginia in the US, and he has gone all the way from being homeless to having over 100 doors. That is a tagline he uses. He now has a good deal more than 100 doors in his portfolio. But as he explains, the way he did all of this was by using seller finance. And seller finance, or also known as vendor finance, is where you get creative and somebody is asking for a high price for a property. And if you can establish trust and rapport and things like that, it may be possible for you to convince the person who's selling, instead of, you having come up with the entire sum of money right there and then, that they effectively take stage payments for this property. And it might, for some of you, you might kind of think, whoa, that sounds crazy. I don't know why I would do that. I do think you should listen to Ray explain this in detail. And there's a number of scenarios where you can imagine it does make a lot of sense to go down this road. And so without further ado, my conversation with Ray Glimp. Ray Glimp, welcome to the podcast.
Thanks for having me.
Ray, it's great to have you here all the way from West Virginia in the US. Tell us, as I was just explaining to you, we have an international audience here from all over the different parts of the world. You're in the US. Why don't you just explain for those guys that don't know anything about you? Let us have a little bit of backstory as to who you are and why you're here today.
Sure. I appreciate the introduction. So I'm Ray Glimp. My story is from homeless to over 100 doors. I think I have about 140, 150 now. We don't count doors anymore, but kind of the American dream. The American dream is still alive. Someone who pretty much had nothing but opportunity and was able to succeed. And I think that's something that we don't hear enough about in today's world. We see instant success, we see celebrity success, but someone who truly is working their way from the bottom is something that we don't see much of. So happy to be here.
Ray, that's a really inspiring initial intro. And we're going to get into some of that stuff if you don't mind. I think people are going to be very interested because I have some coaching clients, and a lot of the time the concerns that they have is that, they don't have the money to get started, or if they do have the money, maybe the mindset is the thing that needs to kind of get worked on and stuff like that. And so this is a great conversation we're going to have today. Tell us about your start in the world. When you say homeless, when did that begin? And were you interested in real estate before or after that?
Yeah, so I actually got into real estate by mistake. I'll be honest with everybody. I got into it by mistake. In homelessness, I was homeless twice. One was not by choice. The first time it was during September 11th, after September 11th, 2001. We lived in New York City. My parents lost their jobs after that, and we had to go to a homeless shelter. It was just out of our range, high inflationary times in the city. So that was the first time I was homeless, and it was terrible conditions, but it shaped the rest of my life and the mentality that I carry forward with me. Um, the second time was when I left New York City and came to school in West Virginia. That was the second time. That was voluntary homelessness. I slept on a couch with my cousin. We just wanted to be better. So I came here with the opportunity and chance to go to school and get in-state tuition. So those were my two times. But real estate, I stumbled upon. I heard some guys talking about the advantages of investing in real estate, guys that were making a lot more than me. Having conversations like this were a rare thing. And I knew from that period that real estate was something that I needed to get involved in.
And when you say you got into it by mistake, I mean, explain that first deal that you,
Yeah.
because I've used the term before, accidental landlord, where people didn't intend to invest in property, but suddenly find themselves as a landlord.
Yeah. So my story was a little bit different. I'll tell you, I was at the bar with about 7 or 8 gentlemen, um, close friends at the time, and they were all making more money, lawyers, attorneys. One guy was in politics, one guy was in a restaurateur, and they were all making more money than me. And they started talking about, hey, we should buy a property, all put 5,000, 10,000 in, renovate it, refinance it. And at that time, it was just like mind blown. And so I remember saying, okay, I want to do it. I went home, started doing a research and investing in real estate. And I came back to all the guys and said, hey, look, I'm ready. I want to invest. And every guy said, nah, we're not going to do it. Everybody backed out of it. And at that point, I had committed so much time and knowledge to learning and commitment to learning that I said, I have to do this. So I went online on what's called Craigslist, kind of like a sketchy
Yeah,
website. Yeah.
I know Craigslist. Yeah.
I went on Craigslist and I found a property and it was super affordable, very cheap, but I'll tell you, it was in a wrong neighborhood. I probably overpaid for it and I overdeveloped it. But, at that time, real estate worked out and worked well for me for what I was doing. And at that point, I still remember I got that first check from the tenant, right? That first rental check. And to anybody who hasn't invested or is looking to start investing, when you get that first check, your life somewhat changes. And the tenant gave me that first check, and I was like, wow, if I can duplicate this, I can do well. And so that's how it started for real estate for me.
That's a great story. And tell us, I mean, when you start out at that very early beginning, like there's a big steep learning curve. You've got to figure out a lot of different things about, the law and the tenants and, tell us, what did you find like the most difficult thing to kind of get your head around initially?
Oh man, I made so many mistakes, and I'll tell you, folks, when I got started, there weren't many podcasts. There wasn't a platform like this. There wasn't no bigger pockets or any like YouTube wasn't even a thing that really people watched for that type of information. And so the mistakes I made were, like I said, I overdeveloped the property. I built and rehabbed the property like I was going to live into it. It just
Yeah.
didn't make sense. So it was a beautiful property, but it was in a terrible neighborhood. So that was one of the biggest mistakes I learned. Then the laws and learning of the laws, that was something that I kind of took with like I'll just go and do it as I go. That is not the best approach, ladies and gentlemen, to do real estate for sure. Because sometimes the tenants, and I learned very quickly, the tenants may know more about the laws than you do, and you
Yeah.
don't want to be in that position.
Yeah, that happens a lot, and suddenly they're quoting back to you, their rights, and you're like, "Oh, really? Shit, I didn't know that."
Yeah.
Yeah, yeah. And tell us, Ray, I mean, at what stage, like, what were you doing besides real estate at the time?
Yeah, so I had got into the bar and restaurant industry. I had an opportunity before I knew what seller finance, and if you're in real estate, you know what seller finance is now. But before I knew what seller finance was, I had an opportunity to buy a business, seller finance, which was a bar. I bought the bar, seller finance, did really well with it. I didn't crush it. I never made six figures with it. I just want to put that out there either. I wasn't making six figures at that point, but I did really well with the bar industry, kept my expenses low, and then was able to use that money to further invest.
Great stuff. And seller finance, just for people who are unfamiliar with the term, explain.
Yeah, so seller finance is pretty much you're buying something without the bank. So the terms came from the seller. He ended up doing zero money down for the bar business, zero money down, and I paid him $2,500 a month, and I think the interest rate was 7%, which at that time was high, but now we looking, interest rates at 8.5, 9.5. But I didn't have credit at that time. I didn't have great credit, so he financed it with the term of those, or with those terms, he financed it.
And so for, like what you're sort of describing there is a guy that did he want to retire, or why was he, so he wanted to retire and he
Yeah.
basically, this is his way to exit, is to
Mhm.
sell it to you, but to do it incrementally over a period of time.
Correct. Yeah, because for, when you're selling bigger businesses, and it goes to real estate too. When you sell, bigger businesses, you want a certain price. Your head is set on a certain price, and the market may not give you that. But if you're willing to do finance and buy and sell over terms, you can get that. And I'll give you an example. Real estate's the same way. We just purchased the asset, $2 million asset, with I think we did 0% financing, 0% interest. Now the asset wouldn't appraise for 2 million. It was probably worth 1.5, but at 0% over 30 years, it makes a lot of sense to do that.
Yeah,
So
yeah.
that is the advantage of seller finance, creative finance terms right now.
And it's a creative way to do it. Like, so the guy that's selling it to you is has agreed to sell at 2 million what is worth 1.5, but then he's getting incrementally paid over a period of, did you say 30 years? Yeah.
30 years. We set the term for 30 years. Now, what happens if I default by some chance, then he gets to take it back. So that is the disadvantage. But in the same way, the bank would take it back and foreclose on
Yeah.
you.
Yeah, yeah. And so does the money that you've paid him up to that point, does he get to keep all of that, or is that sort of seen as you making incremental payments?
It would be an incremental payment, so it would be pretty much buying it down. So let's just say we bought it at 2.5. My goal is to get it to the point and make the asset worth, 2.5, 3 million. So if anything happened, then we could sell the asset before
Right.
it would ever be foreclosed on, and we have, equity in the deal.
Got it. Yeah, yeah. That's a good way to do it. And have you done that a few more times?
Oh man, we did last year. I think I did about 4 or 5 million in
Seller
creative
finance.
finance. Yeah, and then the year before that, I did about 6 or 7 million in creative seller finance. So uh, it's right now with high interest rates, it's one of the best ways I'll say to buy at this point in time.
That's really interesting. Why don't you take us through the process? I mean, how do you go about finding a deal, first of all, that you know to be seller finance, or is that something that comes out in the discussion?
So both. So one, if you look, and you can find it on, like, I think if you look on Zillow or even places like LoopNet, or just check with your realtor and ask people, hey, look, are they interested in seller finance? It becomes more of a conversation and relationship to agree to seller finance terms. Some landlords, especially more commercial savvy landlords. So, and when I say commercial, 4 or 5 units, they own multiple units. They're more open to it because one, they get the interest rate, not the banks. Um, if they're financially set, then they can take the brunt of not being paid that full lump sum at that point, knowing in the end game they'll make a lot more. And look, here's the thing: when you go to the bank and you get a loan, let's say you take out a loan right now at 8% at, let's say, $2 million. Well, the bank is going to make 1 million on that note. So
Yeah.
why not the seller make an extra 1 million over time? And then there's
Yeah,
also
no, makes
the
a lot of
offset of
sense. Yeah.
taxes too. Not getting that huge capital gains tax up front, you can offset that tax and kick it down.
Yeah, yeah, it's interesting. And I mean, how does it compare? Like, if a guy was renting his property out, if he owns a place that's worth 2 million and he's renting it, he might be getting, what would the maybe 15,000 a month or something like
Yeah.
that rent?
Yeah.
And you come along and instead of paying 15,000 rent, you're basically making down payments on the thing. How does it compare in terms of an amount? Because if I was selling a property, I'd be thinking, okay, well, I can continue collecting a rent,
hmm
or I can basically start giving away this property incrementally over time.
Yeah.
Is it advantageous to him as well?
It is because one, for him to continue making that amount is there's going to have to be either a good property manager, which we find when we do a lot of seller finance. It's just mom and pop. There's no property management. And
Right.
two, he may be coming up on capital expenditures right at that moment. So, they may have to put on a new roof. He may have to do some foundation structural work. And at that point, it may just not be worth it for him. You
Got it.
know, he's also may have seen most of, if not all of the depreciation over those, 20, 30 years. So the asset depreciation may be down. So it just makes more sense for him at that point to kind of let go of the asset.
Yeah, yeah, I can understand that. So, and explain like from the point of view of you've got 140, 150
Mhm.
units now. I mean, are you trading any of them or are you just keeping everything?
So at this point in the market, I have not sold and I don't intend to sell. We're doing a couple flips a year, but I do not intend to sell. The units and I have right now are pretty much B's and A's. I have some C class, but the C's cash flow very well, and selling right now is just not advantageous, especially in today's market. You know, the housing crisis, the shortage of housing, and most of the assets that I own are going to be multifamily. So selling a multifamily right now is a little bit more difficult unless I was to do seller finance, which to me just doesn't make sense at this point in my career.
Because the interest rates are where they are. Yeah,
Yeah.
it's harder.
Hmm.
Okay. It's
Yep.
interesting. Okay. And so I mean, from the point of view of would you, if somebody came to you now, would you actually turn around and become a seller doing seller finance? You'd
Yeah, of
look at that
course.
as well.
A hundred
Yeah.
percent. I would look at that as a better strategy than, and I've sold deals on seller finance.
Right.
100%. I'm closing on a deal here in the next week or two that I'm selling on seller finance. Um, Seller finance again just makes more sense. Certain people may have a good reputation, but they can't get approved for some whatever reason. And worst case scenarios that I take the asset back.
And so, yeah, that's really interesting. I must look into that. Here in the Irish market, we have like it's just crazy. It's just there's just such an acute shortage of property that prices are kind of continue to go up every single year. So I'm not sure it would be that easy to convince somebody to do it. But the same dynamic exists insofar as interest rates are quite high. It can be hard to gather the money up and stuff like that. So it sounds like a great way to kind
Yeah,
of look at
it
it.
it is a tool because here's the thing: higher prices create an affordability issue, right? So if I list something at 10 million, not everybody can afford 10 million. Your buyer pool is very limited. But if I can afford 10 million and you as a buyer, if you have a strategy, so typically as a buyer, when I'm going in with a strategy, I know I'm going to have to add or force value. That is one of the strategies I'm going in with to increase the rents. So if you're going in with the asset, you just want the spread. At the end of the day, as an investor, investors care about the spread, the margin in between the debt and leverage. You want that margin, right?
Yeah.
And so it doesn't really matter the asset price versus the spread that you can make. And I remember hearing it. Somebody said, "Would you buy, a single family home for $10 million?" And everybody said no. Like it doesn't make sense. But what if I told you that the monthly payment was $1 a month and you had to pay me over 10 million months? You would buy it then because you can take advantage of that spread.
Of
That's
course.
all we want. We want to make sure that the spread makes sense.
That's interesting. And I mean, in terms of the deals that you've done, you've hung on to most of them,
Mhm.
but you're trying to add value at the same time. And so, have you built up a lot of equity in some of these deals?
Yeah, yeah. So a lot of times, and it's a double-edged sword because a lot of times the interest rate is so good that it doesn't make sense to really refinance them, right?
Yeah.
And we just refinanced, and it kind of hurt me a little bit to refinance, and I did with a bigger strategy in mind, but we just refinanced a deal that we pulled out about 500,000 out of because we had that much equity just sitting around. We had equity sitting around. I think the rate was like a 4% or 6% rate, and we refinanced it for 8% rate.
Right. So it
But
cost you a little bit. Yeah.
it cost me more. However, we had raised rents enough. We still broke even, but we kind of lost our equity position. But it made sense to pull that money out and reuse and redeploy that money. So, but most of the time we end up holding on to these assets as long as we can because we're doing just principal pay downs, what it feels like, especially in today's higher interest rates.
Yeah. And if somebody, if you're paying somebody over 30 years, it seems to make sense because the payments will be pretty reasonable at that rate.
Yeah, yeah.
Uh,
So
uh,
these assets I mean, they're generational assets. That's how we look at them.
and the guy that you're paying for 30 years, like what age bracket is he in?
So he's in an older age bracket. I think he's about 75, 80. So he understands when we went to the closing table, he understands that he will not see all these payments. The
So
money
it's his family that benefits. Yeah.
Yes, yes. The money was never the mentality for him. It was more the passing it down, not realizing the huge capital gains expense, and then passing it down so his family will be taken care of. Because here's the thing, a lot of real estate investors think, hey, when I die, my kids will take this asset. But most kids end up selling the asset when it's gone. A
because of the
lot of real
tax.
estate yeah, a lot of real estate I've purchased has been from kids who didn't want their parents' real estate and their parents' headaches, so
A lot to be said for it. If we could do that over here, I think it would really open up the door for so many people because what happened in Ireland back in 2008 is the banks were all lending. It was, the Lehman Brothers collapsed,
Mhm.
brought down all the Irish banks as well. And they were very, very reckless. They were lending money, 110% down, easy terms. They didn't do any
Same
due.
thing here. Yeah. Yep. We had.
And then suddenly they all got burnt. But when they got burnt, the banks did not give back. Like they didn't go back to their old ways. The government stepped in and took over as shareholders of most of the banks,
Mm.
and they have all these rules and stuff. And so it's so difficult now to finance anything through a bank. So
So
setting
that's why we get away from the banks if we
yeah,
can
yeah,
get away from them. And it could just be a comment like, and I travel a lot. So like I just went to Canada. I spoke at the multifamily conference in Canada. They have what's called vendor buyback, right? So it's the same as seller finance. It may be a specific term, but pretty much you're buying an asset through a purchase agreement, right? It's just a purchase agreement. Same way you would buy something without a bank, you would have a purchase agreement and you agree to pay John Smith XYZ over this many years and but set the terms up in a way that they're both beneficial for both parties, right?
yeah,
And you both win because at the end of the day, the banks are the only one who win. When you go do a transaction, the banks win,
yeah,
right?
for sure. Yeah, and especially in this country, I've noticed that the banks now, when you go to talk to a bank, you have to pay for their lawyer to actually review the documents and everything like that. Then you
Mhm.
pay them an arrangement fee and you pay them
Or
all these.
origination fees and doc fees and we got all that stuff here. We got it here, and it's just like so here we have a lot more lending. I would say like there are lenders for everything. So if we have what's called the DSCR lending program, where it's pretty much a no document loan. You pretty much you're getting loans based on an asset. They don't care about they care about your credit score, but they don't care about, what's your history, how much you bring in W-2. We could go buy a $10 million asset based on this asset will perform.
Yeah, yeah. I love what you said there about buying a 10 million property and just making $1 a month payment. Like
Yeah.
it makes total
Yeah.
sense. Yeah. And the person can convince themselves that they got 10 million for this for the
Yeah, no problem. They'll get it we'll pay you forever as long as we'll pay you $1 for the rest of your life. Inflation will eventually beat that. And this is the other thing, right? So when we buy assets, especially real estate, over long periods of time, inflation will eventually beat you down anyway,
yeah.
right? So
Yeah.
I looked at things that I bought for a quarter of a million. Like I was like, man, that's a lot of money. And now I look at it like, geez, I can't believe I paid only a quarter million for it. And
Yeah.
so that's the value of real estate and appreciation and inflation working for you having an asset,
Yeah. Yeah.
right?
So talk us through, I mean, you mentioned there the fact that if somebody's commercially savvy, that they'll be, familiar with this kind of thing. But I know a lot of people that you're trying to buy from will be sort of maybe wary and thinking, oh, maybe I'm getting scammed here. Is this some sort of sophisticated way that you're going to kind of rip me off? How do you establish that, this is tried and tested? I have a good reputation. Here's my track record. Talk us through convincing somebody that's maybe not completely open to the idea at first.
Yeah, I think it becomes relationship based too. So a lot of the seller finance deals I've done and I'm continuing to do have been based on relationships that I've built with other people. Um, and usually it becomes having a relationship or communicating with the actual seller themselves. It's a lot harder to do it through a realtor, I've found. But if I
Yeah,
can have a conversation with a seller and say, hey, look, I understand. And it might not just be bigger assets too. I've done seller finance, creative finance on single family homes where we'll talk to them and say, hey, look, I understand you've had this listed on the market for 300 days. I'm willing to buy it and I'll pay what you're asking, right? I'll even pay all the closing costs and everything of that nature. Just need you to sell it on terms. I can give you a down payment. I can give you, 5, 10,000, 20,000, whatever it is. There's deals that I've walked into with no down payment, but I just need you to sell it on terms, right? And I can give you the amount that you're asking for. There are a lot of people right now that are underwater, right? There are a
yeah,
lot of people who are tired. Tired landlords are like the easiest ones. But there are people who are underwater who bought at the top of the market right now. They have no equity. And I've heard of stories where people go to the closing table, they have to pay to close on to sell their house, right? That makes
Yeah.
no sense. So instead of paying to close, let me take over or maybe assume your payments, or let's work out a deal. That way, maybe you can get paid still and everybody wins.
Yeah, it makes total sense in that context. All right. Yeah. It's funny how a lot of people will just have a, traditional mindset. They kind of say, I sell it, somebody pays me, that's the end of it, But this is, as you mentioned, creative
Hmm.
finance. And so, Ray, I mean, take us through the mindset aspect of real estate. I mean, for you to start out, like all of your friends are making more, and suddenly you've got this opportunity to get into real estate. Like, how much of that was psychological?
100%.
A
100%
100%
was,
psychological.
yeah, 100%
I
was.
say it's normally 80%
No,
psychology, and
I've done this research. I learned that I think it was the statistic was 90% of millionaires are made through real estate. And I knew, I was like, wow, like if that's the statistic, then I like these odds. I
yeah,
was in a restaurant bar business, and I think only 3 to 7% of restaurants actually succeed, like generationally.
yeah,
And the profit percentage is only anywhere from like a 2 to 6% profit margin. And I started looking at that. I'm like, these numbers make no sense. I need to get into something where I can actually make money. And so once I saw what real estate could do for me and started learning, the skies was the limit.
yeah, yeah, in a big way. And you do a bit of coaching now as well yourself.
Yeah, so pretty much we teach people all through the US how to invest and get started. I think that's the biggest thing that stops people is they don't know how to start, right?
Yeah.
They don't know how to analyze a deal. They don't know tactics to buy a deal. They may think it's money, and money is a piece of it. And sometimes it's mentality, mindset. All these things add up into making you a better investor. So that's kind of what we help teach people. And it's
And
totally free as well. I'll put that out there.
oh,
So
you do it for free. Okay. So it's kind
100%
of
free. Yeah.
giving
Yeah.
back.
Yep.
That's really nice. I mean, there's a lot to be said for that. So it's like a philanthropic kind of venture for you to do this. Yeah.
Yeah.
Brilliant. And Ray, like West Virginia, is that you're there because you went to school there, but is that where your central focus is in terms of investment?
Yeah.
Or
I
do you?
invest in West Virginia, Pennsylvania, and Ohio. So some of the my tri-state area and what I believe will be the next emerging markets. It's been stated many times. If you know the area, you know what's coming. And so the market is going to appreciate, we believe, heavily over the next 5 to 10 years.
Interesting that you say that, yeah. And what is the like describe the type of is there a kind of particular type of deal that you're looking at? You mentioned multifamily, but what is it that you're looking at initially that interests you?
Yeah, so I typically like to buy multifamily, so 5 units and above, or what we call mixed use. So maybe storefronts on the bottom with residential units
Above.
up top. Yeah, those are my favorite, just because those help shift a whole town, right? They can help shift a whole street just by having great commercial tenants. A lot of times we see what we call legacy landlords who they'll let their places sit vacant, right? And what that does, it kind of destroys a community. A vacant commercial space destroys a community. And my goal is to make sure that we bring in investors, we bring in people who want to open businesses that want to give to the community and help the community. And in doing such, we can help the community grow.
Yeah, yeah. There's a lot to be said for it. That was the kind of investment that I used to do predominantly back before 2008. And I would buy the storefronts, and I wouldn't buy the stuff above because the stuff above would be built by somebody to be sold off to owner occupiers. But what I would do is buy the storefronts at the ground floor, and you could go and put a nice mix in that would be helpful for the neighborhood. And so it was usually, a convenience store, maybe a grocery store, and then there would be usually an off license. Back in the day, there was video store like a Blockbuster or something
Hmm.
like that, and also maybe a pizza place or something like that. And that was the kind of traditional neighborhoods, maybe a pharmacy as well or something like that.
Hmm. And we
Um,
see how those can change a community by adding those. You're adding value, you're giving people things that they need.
Yeah, because otherwise they got to travel a long distance to get to it and stuff.
Hmm.
And often I found, although it may be different now, but I found that the storefronts were actually more valuable than the residential property above them.
Hmm.
And a lot of people don't, well, it's changed since, I mean, it's funny. I owned a couple of units that had Blockbuster in it, and I thought that this was a great investment, because it was a huge company. Fast forward a couple of years and it went bankrupt, and you realize that the world is changing, and retail has changed quite a lot. Ray, tell us about where you see the future. Like you mentioned there, you see the prices rising in the tri-state area.
Yeah.
Where do you see the market going in general? I mean, interest rates are a big problem at the moment
Mhm.
for a lot of people, but there seems to be kind of general direction. It seems to be that, we're getting on top of inflation.
Yeah.
Interest rates will probably start to fall in the next while, and that'll obviously turn the cycle back on again. Uh,
Hmm.
what is your strategy and outlook on the future?
So there's a couple points. One, when interest rates go down, it makes things more affordable, right? And so with affordability, will help with housing, but we have a housing shortage. That is a bigger issue, is that there is not enough. I think the US, we're short about 7 million homes, right? So, and builders have stopped building or very slowly are building. So we will have that shortage. There's affordability crisis as well.
Yeah,
So I think over the next 2 to 3 years, 25, 26, 27, we will see somewhat of a housing crisis, which will supply and demand will shoot rent prices. Prices as a whole will continue to rise. I think it'll steady off maybe in like about 28, 29. But we will see continual shortage. I think you'll see prices go up. You may see those bidding wars still. I mean, we're still having some in our area, depending on the price point. So when you go from, and I believe the 200,000 to the 300,000, below 400,000, lowest inventory we've had in a long time. And it
mm,
continues to remain less than 30 days, less than 60 days on market. So when we look at those things, we're kind of just set for, or lower interest rates, making it more affordable for people. We're set for those prices to continue to increase.
yeah. And Joe, your strategy, well, in terms of if rates do start to fall and more people come in because it's more affordable, does
Mhm.
that damage your seller finance strategy?
No, it makes it better because well, one, I'll say, first of all, I do like higher interest rates because it makes it better because there's not much competition,
Right.
right? On a seller finance side, if we can still work out a deal, seller finance, and do lower rates than what's offered than by the bank, then we'll make it happen. At the end of the day, the rates only are affected by if you're doing banking, traditional banking, or a DSCR loan. But if you're not using any banks, rates don't matter.
Got it. Yeah, yeah. And tell us this, Ray. When I was looking at your bio, you've helped, a range of different businesses from mom and pops up to, much, much bigger businesses.
Mhm.
What kind of help do you offer these guys?
So the biggest thing I get a call for now is just analyzation. A lot of people have money coming in, but have no idea where their money is going, right? So, and this may apply to anybody who, living paycheck to paycheck and seeing like, hey, look, I don't know what's happening. Where's our money going? So that is one of the biggest things I get a call for now is, hey, look, we need help analyzing and becoming more efficient in our business. A lot of people are lacking time, and I'm sure you hear it and I think you've mentioned it too, is, there are a lot of people that are they might be rich but time poor,
Yeah, that's
you
for
know.
sure.
Yeah, and so we see that a lot in our industry of people who don't have those values. And I have three like values. I deserve to be wealthy, I deserve to be healthy, and I deserve to be free. And I want all three. Wealth, if I got wealth and health, but I don't have time freedom, I'm not living a right life. So I think people deserve to have all three of those.
Yeah, there's a huge amount to be said for it. And like freedom is one of the values that I value highest. And the
Mhm.
ability to have time freedom, money freedom, freedom of location is actually something that's become more and more. And then freedom of your purpose, like what are you spending your time doing?
Mhm.
And so those are the four freedoms. Yeah, very interesting. And so Ray, in terms of the markets that you're sort of in, do you see yourself going beyond the tri-state area, or do you try to kind of keep it within that because that's your area of expertise?
I'll be honest, like even when I talk to new investors, I say master your market, right?
Yeah,
Nobody knows your market like you. One of the first deal I actually did, I would have did better if I knew the market better, right?
yeah,
I bought on the wrong street. If I would have bought two streets over, I would have did really well. But because I bought on the wrong street and didn't know the market, I didn't do as well. So master your market is the biggest thing. So I like to invest here because I know this market. I'm one of the top leaders in this market, and I think I'll continue to be as long as I continue to master it. So I'll stick to my markets that I know very well.
So talk us through your, how would you get to know a market? If you're looking at buying a property, talk us through some of the due diligence that you would do in terms of just understanding the street and
Yeah. So I'll take you one from a high level and then I'll go very specific. From a high level, it'll be things like knowing your crime data, knowing your census data. What is there? Are people coming in for jobs? Are people leaving for jobs? Is this a crime-ridden area? Or is this a safe area? Those two things at a high level. Then we can go to like the basic level of the school systems, right? How good is the school where we're at right now? Also, again, it becomes a low data of crime. So you have a wide data of crime, then a low data of crime. Homelessness. What's the homelessness situation? What is the population? What are the jobs like?
yeah,
Those are the things that I need to know before, and my town the town is very easy to read that I'm in too, and I see it as an easy town. But and people might recollect with this wherever they're investing. There's a place that your blue collar workers live. There's a place that the white collar workers live. There's a place that lower class individuals live, middle class. Figure out what class that you're going to target and invest in that market.
yeah. And I mean, I guess the system in the US is a little bit different to what it is here, but how much of your taxes and things like that? I mean, I know in real estate in the US, you've got all these kind of advantages to the way
Mhm,
you can kind of
mhm.
forward, you can depreciate your assets and things like that. Does that play into your strategy with seller finance?
It does and it doesn't. At the end of the day, whenever you're looking into depreciation, you're gonna get depreciation 29 and a half years on the residential, 39, I believe, 39 and a half years on commercial. You'll get that depreciation. It does take a play, but not as much. I don't really calculate it when I'm thinking about seller finance.
Right, right. I love the term. I love the idea of doing paying somebody over 30 years. That's I'm going to
Yeah.
see if I can try that out over here.
Yeah, and see, in the banks, and I don't know about you guys, but the banks here, they'll do a 20-year mortgage, with fixed interest rate. You can get a fixed rate, and here, 30-year fixed is doable. Right now, I think my mortgage, even on my personal, my primary, is about a 2.9% 30-year fixed. You
Yeah, we
know,
don't have anything like that. I mean,
I
the
know.
best we can do here is maybe fix for 5 years at the
Mhm.
maximum. Like, and even that is rare enough. It's usually 1 to 2 to 3 year fix. So I
Well, come
love.
on over. We got plenty. We got plenty more to invest in.
So Ray, I'm looking at the clock there. In terms of advice that you would give, like what is the number one piece of advice that A, you've received yourself, and B, that you would give?
Number one advice I've learned, especially when we're talking about real estate investing, know your numbers. Right? It is so easy to look at a property and say, "Oh, this is beautiful," but most people, I'll say 90% of investors don't know their numbers, don't know how to analyze a deal. If you can learn how to analyze, you can be very successful. And I would give that advice to people as well. If you want to start investing, learn your numbers first, right? It's very easy to watch TV or listen to a podcast like this. And some of us guys, we make it look sexy, we make it look easy, but we've done a lot of work and a lot of research and a lot of due diligence behind the scenes, right? So make sure you do that same due diligence and find a mentor. That was the biggest shortcut I think it did to help me skyrocket in real estate was finding mentors and people who were aligned and doing things that I want to do and living a lifestyle that I dream of living, right? And if you stay around those people, you should be able to exceed and excel.
And tell us, know the numbers. Give us some of the numbers that you would typically look for.
Oh man, so one of the biggest things I'm looking for is what we call a cash on cash return, right? If I spend 100,000 on a deal, how fast am I going to get that money back? Whenever I'm invested, I'm looking for a minimum of a 20% cash on cash return. That means I will have that 100,000 back in 5 years, right? Typically, we're looking at 30. I've got deals from 30 to 36% cash on cash return. You know,
3 years repay.
3 years, and then we do what we call an infinite cash on cash return. So we'll buy something right now. I'm working on a project. I'll share with you guys too. I'm working on a project right now where I purchased a house. We're doing a renovation. We're going to refinance it. We'll have no money in the deal. That's an infinite cash on cash. My money is 100% back to me. I continue to reinvest. So know your numbers and know them from the beginning.
Yeah. Very important. Yeah, yield and capital and all that kind of
Mhm.
stuff. And Ray, what advice now? What age are you now?
I'm 34.
At 34 years of age, if you had the ability to go back and talk to yourself as a 20-year-old, what advice would you give yourself?
Um, get into real estate earlier, right? That was the biggest mistake. Started buying other businesses, and I was like, man, I'm gonna own all these businesses, and I'm gonna be great at this. And then I realized how hard I was working, right? And real estate is the only business I've ever been a part of that has really brought me freedom of time, of money, and of health, right? The ability to have all three. Real estate has been the only one. So get into real estate early is what I would tell my younger self.
Yeah. That's the same advice we all give, especially on this podcast. Anyway, all
Yeah.
right. Well, wait, Ray, if anyone would like to reach out and connect with you, what's the best way to connect with you?
You can reach out to me on Instagram. I respond to all my DMs, all my messages. Ray Ray Glimp Glymph, or you can Facebook or LinkedIn. I respond to all my messages. It's really me talking. So just send me a message. I'll get back to them.
Oh yeah, great. So it's not some automatic machine like yeah, that's destroying LinkedIn. It's just constant every day.
Yeah.
Hey, all these messages, and you know that they're not they're
Hmm.
automated, you know.
Hmm.
All right, Ray, it's really nice I'm gonna go and connect up your profile on the in the show notes so people can reach out on LinkedIn and Instagram and stuff like that. But thanks so much for your time. It's been really interesting, and creative finance seems like a fascinating way to go.
I appreciate you having me today. Been a pleasure.
All right, guys, I hope you enjoyed that conversation with Ray Glimp. Definitely something to think about. Are you getting creative enough with your financing? And at the end of the day, as he references in our discussion today, it is the spread between the payments you have to make to the bank, or in this case to the seller, and how much rent you can collect. And if you're able to pay somebody well over the odds of what they're asking, but you're able to do so in a way that allows you to start collecting the rent straight away, then it could make complete sense. And you would allow somebody to save face and have their ego and be able to go off and say that they got a really strong price for that property, even though they're accepting payments over a long period of time. Guys, as always, pays to get creative, pays to think outside the box. And as I've said many a time before, a lot of the time, it's not a lack of resources that's the problem. It's a lack of resourcefulness. So just get creative and perhaps you can solve these problems for yourself. Guys, I hope you found this one useful. I'll speak to you next week. Take care.